Good morning, good morning. And we are live on Facebook, LinkedIn, and YouTube. Good morning to you. Thank you for joining us on Coffee Time. For those of you who are returning to the show, welcome back. We always love having you. If you're new to the show, welcome as well. And why don't you give us a little hands up or a thumbs up in the chat so we know you are new. I want to encourage everyone who has joined us today to please go ahead and subscribe to my channel or the channel of your choice, wherever you're watching us from, whether it's Facebook, LinkedIn, or YouTube. We will go online every Thursday, usually at 10 a.m. Eastern. However, today we're a little bit off schedule. We had a scheduling conflict, and so we are live today on Tuesday. But so go ahead and subscribe to the channel or the page that you are watching us from, so that every Thursday when we go live, you will be aware. Uh, just a quick introduction. My name is Marie Torossian. I'm a certified public accountant and a chartered global management accountant, an experienced auditor, and a CFO. I'm a CPA advisor and transformation coach. I use my proprietary method, Valuation MT, to help business owners go from their first million to 10 million and more. I'm also an author of a couple of books, the Business Owner's Guide to Operational Accounting, and the Complete Guide to Business Growth, which is available on Kindle. I will be putting both links on the chat, so make sure you grab the ebook or the one on Kindle and learn some of the tricks and strategies that I use for my clients. With me always is my featured guest and my tax colleague, Pedro Gonzalez. Pedro, good morning.
Good morning, Marie. Good morning, everybody. Happy to be here on a Tuesday.
Tuesday.
Yeah. So, Pedro Gonzalez, your business and tax strategist. I have this ebook that, again, we're getting some good feedback. The Real Estate Investors Tax Strategy Guide, where we share, we talk about legal entities, what we call the millionaire tax strategies, audit proofing techniques. If you want to learn how is it that the wealthy gets wealthier through real estate, there's a way to do it, and we share some of them through this ebook, and it's free. The link is available. I encourage you to, if you're really serious about looking into real estate investing, I encourage you to get it. It's a free ebook, and it will give you some introduction and good points on how to improve your situation.
Awesome. Yeah, and I'm so excited about today. But before I tell you guys what we're going to talk about today, I just want to go back and kind of review some of the great conversations we've had, me and Pedro, and definitely has helped our audience greatly. And that's about, we've talked about self-employment, related taxes. We've talked about due dates. We've talked about, and we've done a series on tax planning, what it entails, anywhere from life insurance, SEP, IRA, and every possible piece that you can think of. We've also talked about partnership agreements. We've talked about taxation when you are getting ready to purchase a business. And today, we will be talking about real estate investment. Ta-da!
Exactly.
And which is perfect because we just talked about Pedro's book, and it's literally about real estate investing 101. And from that, we're going to talk bits and pieces about what real estate investment is all about, how is taxation, depreciation, cost segregation. These are little ideas that we're going to give you today. So with that, I'll open up the floor. So Pedro, can you please give us like the first 101 on real estate investment, and how can someone, an average individual that just wants to start getting into this real estate investment, how do they start doing this?
Yes. Okay. So before we get started, as always, I tell you that we discuss legal matters where I'm not an attorney, but I have some at least understanding. I always encourage that anything that is on a legal matter to be discussed, reviewed with an attorney. We have wonderful attorneys as part of our team that can also help you in assessing the proper legal structures. Now,
Absolutely.
what uh, what I would like to start is with a little question that I also ask some people when they get into real estate. We have met people through either together individually, that you see them frustrated with real estate investing. And so, you know, in one of the questions that, do you feel like you don't have control over the amount you pay on taxes? You know what I mean? And that tends to be an issue that, that they see that they're into real estate, but they don't see like it's not happening the way it's supposed to be when I was told to invest into real estate.
Hmm.
So
Interesting.
that,
Yeah.
that that's what kind of got me. I'm sorry.
No, that's interesting. That
Yeah,
someone was just I was told to invest. So okay.
yeah. And then you read and I'm sure you have seen YouTube videos of
Yeah.
becoming a gazillionaire in real estate, but somehow you jump in, you take the dive, and you don't see it happening for you. You know what I mean? So you see all these other people supposedly it's happening for them, but it's not happening for you. So through the our tax programs that we design for our clients is you can get started then is to have that control. That's kind of what we have done is to hone in into the real estate taxation and investing, how to truly bring that to you in a way that you can maximize the taxes and the tax loopholes, if I may say, that that can help you. So if you're not right now, if you happen to be, I'm telling you, if I look at your return, if you are in real estate, you invest in real estate, and either you or your spouse can qualify as a real estate professional, and you still paying too much in tax, I can tell you, usually boils down to two things: either you're not investing enough in real estate, or you're not taking full advantage of tax loopholes. And this is
Mm,
what, again, our the smart tax program that we have uses business and real estate in the overall methodology on how then to build wealth through the areas of real estate, combination of legal structures, and maximizing your tax loopholes. One of the things we discuss in the book, I'm going to give a couple tidbits on the ebook that we have, and one area is depreciation, which is to me one of the, if not the best, or probably one of the best friends of real estate investors. Unfortunately, not utilized properly, it sometimes gets neglected. It gets, it's something like people not. I think what happens, a lot of the real estate investors do not understand it, and so, and a lot of the preparers make assumptions, and that's the problem. You know what I mean? You're not really, this is an area that you can maximize, but you're not utilizing it properly. So
mm,
depreciation is valuable because unlike the any other rental expense, you don't have to incur more expenses on that once you incur the initial cost. I mean, you made the initial investment. So like repairs, if you want more deduction to repairs, you have to continuously incur cash outflows. Where
absolutely.
the
Yes.
depreciation is a one-time investment. If you did this correctly, which we're not going to get into that part, but that's leverage. You probably didn't put, the $400,000 initial investment in the property. Most likely is that you finance. If you did this correctly, is that you
Correct.
financed it, and so you're taking a deduction, even though you didn't pay the whole $400,000 initially, but you're taking that deduction. So this is why it's so powerful,
Right.
because you can then, by combining the leverage, and then you take acceleration of depreciation, and you are putting together two very powerful strategies to then reduce your taxable income. So, but what I wanted to kind of bring to your attention is, about depreciation, something in particular that, again, at times what happens, it gets misclassified, and that is because there's a difference depending on the nature of the property. And if you're new into real estate, sometimes that doesn't, you hear about certain things about depreciation. You know that they're supposed to be taking a certain portion per year, but you don't really understand it. So to give you a little bit of a synopsis here about what happens is that yes, the depreciation is taken annually, but two properties of the same amount can have different results. Uh, for example, if you own a motel with a depreciable basis of $1 million, you will probably get approximately $25,600 approximately per year of depreciation. Now, if you own an apartment building with also a $1 million depreciable basis, your depreciation will calculate somewhere around 36,000. Now you wonder, okay, so why the
What's that?
difference?
Yeah.
Why, they're both the same amount. Why do I get different numbers? And that is recovery periods. It's another element that the IRS puts into the difference is recovery periods, and that is because the motel and the apartment, while they're both real estate uh, properties, they are not being depreciated at the same what we call life, the same
The
period.
life of the building. Yeah.
Correct.
Yeah.
One is treated as a commercial and one is treated as a residential. Commercial properties are 39 years, residential 27 and a half. So that's one thing that you have to keep in mind. Obviously, the longer the period of depreciation, the smaller the depreciation, the shorter
Correct.
the 27, then
Yeah.
you get a little bit larger depreciation. Now, the with that said, now what I would like to bring up then is what then constitute residential? Because again, you might think as it's evident it has to be a house or something like that, but you're gonna start realizing that not necessarily. Residential, when we look at what if you go by the definition, what the IRS states is that it is, and I'm going to read it because I want to make sure I don't misquote it, but basically what it says is that is a building or other structure for which 80% or more of the gross rental income for tax year is from dwelling units. And you might go, what?
They make it so
I know,
complicated, right?
correct.
Not a
Because
simple
instead of
English.
telling you, listen, it has to have a roof and it has to have, I don't know, a toilet and a kitchen. No, it doesn't say that. What it says is that it is has. So you're probably going like, what?
What?
And then on top of that, now they're throwing something else, and it's called dwelling units. What the heck is a dwelling unit? Because and that's what causes a lot of the confusion and a lot of and that's what we do. We delve into this, and I'm gonna share a little bit, how the process we go through. Because then, okay, so we go into, okay, so now we identify that there's at least two types. We're gonna have residential, you're gonna have commercial, in
Yeah.
depreciable property, because obviously you have land, but right now we're focusing on depreciable property. So you're gonna have commercial, you're gonna have residential. Now, if I want to know what is residential, okay, so we define what is residential. Residential has to have at least 80% of the gross income has to be from what they call dwelling units. Okay, so what is dwelling units? So dwelling units is basically what we consider to be has to have, in essence, a certain level of accommodations that is basically a house or an apartment that provides, in essence, it cannot be in what it is. It says it does not include then a hotel, a motel, or any other establishment that is transient in basis.
Transient.
Transient
Yeah.
basis.
So it's
See, they
not like
continue going. You're going through a little spiral. You get yourself dizzy. But
yes.
basically, is yes, a residential. Basically, what it's gonna be is something that has to have a long-term
Yes.
basis. It cannot be
Mhm.
transient. So that's one thing, one key. And the reason I'm going to bring this up because it kind of makes sense a little bit later. So it cannot be transient. It cannot be a hotel. It cannot be a motel. Uh, and one of the questions then is, what about a can a boat be a residential?
That's a good one.
Yeah,
That's a good one. Can a boat, because a lot of people, especially here down in Florida, Miami, they may have really nice boats that they live on.
correct.
Good one.
So I'm not going to give you the answer. If you want the answer, call me. but but you can see then when the definition that there's provided, that's why it doesn't say a roof. It does not say that it has to have a certain number of bedrooms. It actually doesn't even say bedrooms.
Yeah.
So
So it's
what
all
about a
by
motorhome?
purpose. The
You know what I mean?
purpose of use.
So, uh, but I think you get the point. You know what I mean? So then later, so go here. Now it talks about transient. It says it cannot be a motel or hotel. Now, then what is a transient? What is transient use? Now, there's a older definition that's still being used, and even though the IRS has, in essence, removed that terminology, but in essence, what it is it cannot be if a unit that has is occupied for less than 30 days.
Okay.
That's why when you go to hotels, if you're gonna have a long stay, it causes a little bit of a complication for them. They have to do certain paperwork to make sure that if you're gonna stay there for longer, because the reason is that the transient use, they might have to move you to another room or something like that to make it then for them to comply to still be a
Yeah.
hotel. Now, why do I bring up? We went from the commercial versus residential, then we went into okay, so what is residential? We discover okay, residential is a dwelling unit. What is a dwelling unit? Then within the definition, dwelling unit brings up the term transient use because it cannot be transient if you're gonna be now a residential. Now, what is it that's becoming very popular in today's environment? Airbnb.
The mobile work and
Airbnb.
yeah, the Airbnbs and all that. Yep.
Exactly. Now, I can assure you that a lot of people right now have misclassified their Airbnb properties because, according to the definition, if it's transient, it cannot be residential.
Hmm. So if someone has an apartment, a nice condo
Mhm.
right on the water, and they're
Correct.
Airbnbing it, it's not a residential property.
It cannot be residential because of the short-term leases that they're gonna, because that's the whole model. That's the platform of the Airbnb or anything that is in that platform of short-term rentals. Now you have converted something that's why I said, it's not what you may think. Yes, you can have two properties. Now, well, let's go back and now let's not talk about a hotel versus a house. Now you have two houses side by side in the same neighborhood. One is being rented on a
Hmm.
short term, another one is rented
Long
on
term.
long-term leases, year
Yeah.
leases, the typical leases that people do. So Marie has now two properties in the same neighborhood, one side by side. She's renting one on some sort of platform like Airbnb. Another one is long-term leases. One is going to be residential for her. The other one is going to be commercial.
That's amazing. Yeah.
And I can assure you, a lot of people right now have misclassifications in there. And that's a risk because then again we talked before, the amount of audits are going to come up
Yes. Yes. You mentioned
because
that.
they're
Yeah.
revamping that area, and these are areas that they're discovering. They probably know different areas they're going to be targeting, and that's going to
Hmm.
be one is depreciation. They're going to be looking at those things, and if you have a Airbnb type of models, I will encourage you to make sure that it's properly classified to prevent your exposure to unnecessary headaches. But the going along with the depreciation, and why is the depreciation your friend if you're into real estate investing? Again, it provides you, in essence, cash flow. You know what I mean? Because then what you're taking is, if you can classify as a real estate professional,
Hmm.
which is another topic of discussion that we can go further. But this is another area that we look into. Can you classify as a real estate professional? And the reason is because now you are not capped at the 25,000 losses. Real estate is considered a passive activity, except for a real estate professional. Now,
Hmm.
if you're not a real estate professional, your losses are capped to 25,000. So you have, let's say, $100,000 of revenues on rentals. You have $125,000 of expenses,
Expenses.
including
Yeah.
depreciation. You have $25,000 of losses. You can take that, and I'm going to make it very simple without getting into other topics of your AGI or anything like that. Let's assume that you can take that whole 25,000. Now you can take that against your wages, your ordinary income.
Sure.
Now, What happens if you're a real estate professional is that you're not capped by that 25. What happens if you are not a real estate professional, but instead of 125,000, you have $150,000 of expenses, meaning you have now $50,000 of losses, then you can take 25. The other 25 is suspended. It's not, you don't lose it, but you cannot use it.
Right. You can take it
I mean,
the following year.
correct. And that's why some individuals you're gonna see that they have these suspended losses. They gotta continue accounting for these suspended losses, and it's
Mhm.
critical that they do that. And if you have in this situation where you have a lot of these suspended losses, to make sure that your accountant, your preparer is tracking this because you don't want to lose it. You know what I mean?
True.
You didn't use it in year one, but you can come back later
Right.
and you have either a big windfall, you're gonna sell the property, and now you can use those suspended losses to offset.
Towards, yeah. Yeah.
So
Makes sense.
that's why it's critical that all that is done properly. Uh, but if you are a real estate professional, then you're not limited by that amount of losses. So it's beyond of the conversation that I wanted to have today about depreciation, but it's another area that can be, when you combine the depreciation, the real estate professional status, if you can classify, and and something I wanted to mention about the real estate profession. Some people assume, well, I'm a realtor, so am I a real estate professional? Well, you're a professional in the field, but for
Right.
tax purposes, you might not be a real estate professional. That's the difference. I mean, people
Mhm.
assume, um, I have investments in limited partnerships in real estate. Am I a real estate professional? Not necessarily. There's some specific rules that you have to follow to be able to classify. Again, we're not going to go through the details, at least not today. If you want to, again, know more, that I know in the ebook we talk about it, and if you're really interested, I would suggest a consultation because again, there's some very
Absolutely.
specific areas that has to be looked at, and we do that. We go through, if you're serious about real estate investing, we look and see, do you qualify, or how can we help you qualify, and what things needs to be documented so that you classify as a real estate professional, so then you're not limited by those laws. Because now, again, this is that you have to be in essence serious about investing and not just have one property here and then now I'm a real estate professional. It doesn't work that way. But again, the other aspect I wanted to discuss today, in addition to just depreciation, is the acceleration of depreciation using cost
Yes.
segregation. That's a tip number three. So we talked about depreciation, your real estate professional status. If you can classify that, that can give you some open doors for you for larger deductions. And number three is the cost segregation. Cost segregation, if you have again a good portfolio of real estate, I would encourage you to at least take it into consideration. Well, we have found that it does pay off. That's an investment you have to make because then you have to pay for, in essence, an analysis, a cost segregation studies, and that's usually done by an engineer. They're going to go through, in essence, pick it apart. A building is not just a building has components, and those components can be depreciated at a shorter life.
Hmm.
Windows, certain,
True.
I mean,
True.
certain, there's certain parts in there that you can take and depreciate, and the report will say, what the different lives they will fall into, or
Right.
types.
Yeah. I mean,
So
the depreciation schedule could be massive.
correct. I mean, you like going back to that example of the $1 million property. If you don't
Yeah.
do a cost segregation, you might have, and what most of the people will do is that they will go, most of the tax preparer, they will use a rule of thumb of 80/20. I will
Right.
not suggest you do that, but I
Right.
know that it is done. And I
Yeah.
can assure you, if you go through the depreciation schedule, you'll see that usually the split is, if they have not done an actual study, or they usually go 80/20, they put 80% to the building, 20% to land.
Everything else. Yeah, because let's say if the owner actually changed, let's say the AC units, right? So that's a massive investment. That's a
Right,
separate line, and it
right,
could be depreciated at a different rate than the window upgrades, or changing the whole let's say changing the roof, for example,
exactly,
a roof upgrades, or the outside walkway, or internal carpeting, or something like that. Each one is it's a separate type of an improvement.
exactly. When you buy a building, let's say, for example, you buy yourself a fourplex, so it has a little building structure. It probably has some landscaping, has the land, has a
Hmm.
parking lot for the 4 units. All of that, it's probably you bought it for, let's say, the $1 million. And unless you pick that apart, what happens is we're gonna take this whole $1 million, and we're gonna, let's go ahead for now and say 800,000. Let's say it works out to 80/20. So then you're gonna take 80%, 800,000. That 800,000, we're gonna go and depreciate that over 27 and a half. Now, I can tell you that without doing a cost segregation study, the landscaping area is 15 years, meaning you have a shorter life. The parking lot is another depreciation, and so
Yeah.
you can see that why is it important to go as a very minimum? You know what I mean? Just see
Yes.
if in your purchase agreement, if
Yep.
those can be segregated. Now, most of the cases cannot be. I mean, sometimes you get this lump sum number, and that's why the cost segregation study is worth it. I mean, to go and get yourself a cost segregation study, especially if you have
Yes.
multiple units, and if you're serious into this, is to accelerate that depreciation using cost segregation.
Yes. Yes. Absolutely. And we work with different professionals that
Mhm.
are very specifically focused in cost segregation as well. So in different areas of business.
Yeah, yeah. So right there, you have a couple tips in there. If you're even if you're new into the real estate investing, is again look for professionals that can help you maximize. That's again when I see that somebody's into real estate and they're
Hmm.
not achieving the goals of that should be achieved through real estate investing, is typically either they're not properly set up, they're not
Hmm.
investing enough, or it's going to be that they're not utilizing the tax strategies available. That or call it tax loopholes, call it tax deductions, tax strategies that are all available, and it usually boils down to that. It's going to be that they're not maximizing, they're not utilizing it properly.
Yes. Absolutely. Absolutely. And then something we had mentioned earlier, we were talking about, sometimes it could be as simple as, sometimes they need this tax strategy, sometimes they need expenses to manage their real estate, and sometimes they're just probably not even charging the proper market rate possibly for their business. So there's so many different types of analysis that can be done to make sure that your real estate investments are actually providing the cash flow that you're expecting them to. It just
Correct.
needs to be analyzed in many different ways to ensure that you're getting the most out of accounting and tax strategies to help your real estate investments actually bring you the cash flow that you're expecting.
Correct. Correct. And now, in addition to the tax strategies, the other aspect is, you and I have talked to this in multiple
Yeah.
occasions, is the financial analysis.
Yes.
You know what I mean? For example, here in South Florida market, having high vacancy is, you gotta wonder why. Why is this happening? How can it
Sure.
be in one of the hottest markets that we have?
Yes.
How can you have vacancies? The other one, like you said, is market rates. I mean, are you charging the market rates that for the area? You might be fully occupied, but
Yes.
maybe you're not cash flowing. It may be because you're not charging market rates. You have not done
Exactly.
a market study to bring your rates to market level. So those are kind of ways to a good accountant or a good CFO, somebody that
Yeah.
really can help you analyze your numbers, will make a huge difference for you. And to me, every dollar do you invest in that, it pays off. You get a higher amount of deductions. You're accounting for things properly. You're not capitalizing things that should not be capitalized, that
Yeah.
should have been expensed. You're capturing your expenses properly. You're in essence, one of the areas that I know that you and I work a lot is in the area of audit risk.
Yes.
Minimizing their exposure to audit risk, analyzing those numbers before you get a notice from the IRS telling you, you're going to be audited. I share with you experiences I have had and why they get audited. You know what I mean? And one of the areas and one of the cases that I share with you was, an individual that had a high amount of repairs. the end result was we were able to get the positive result for this taxpayer, but could have been prevented
Yeah.
by simply properly classifying uh, the the large amount of expenditures that was shown as repairs. And again, somebody with a good understanding about real estate accounting would have probably most likely prevented this and avoided the unnecessary audit.
Yeah, and this is the stuff we've talked about where there's a big difference between when people expect an accountant or a CPA firm to do a bookkeeping, but then, what we really focus on is our, providing the monthly or quarterly specific reviews where we actually are analyzing the numbers, we're telling our, the business owner or real estate, investor, this is what the numbers are saying. This is something funny or not funny, or this is an opportunity. This is a challenge. Is this truly all what you're saying it is? Can we look at a few documents, just to make sure we're categorizing things in the right places? And that's because we want to protect and support our clients and make sure they never have to be audited. We want to make sure we're protecting them because
Yeah, and listen, if you get audited by itself, it's not
it's
a
not a bad
bad
thing, right?
sign. What it is, audit proofing, and that is the area that we then help you is yes, we want to mitigate to bring that audit risk low, but
Low.
also audit proofing. You know what I mean? And that is the
Yeah,
documentation that you and I have talked multiple times. You know what I mean?
very
It's
important.
having that documentation that if in fact you'd have to incur those large amount of repairs, and there are repairs, and we're not going to capitalize it, then
Right.
don't cheat yourself. No,
Yeah,
no, I'm afraid of an audit, so let me move it to capitalize. Why? It's a repair, so it is properly
true.
classified repairs. Just make sure you have documentation. That's what a smart CFO will go and say, no, 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 no. It is
Yeah,
repaired, but let's make sure that we have everything to back it up.
absolutely.
That's what the investment should be. Do not cheat yourself uh, because you're now afraid that you're going to get audited.
Yeah, absolutely. Absolutely. All the documentation is properly set up and ready to go should anything arise. And that kind of, and that's kind of natural to us because we both started our careers in auditing. So
Right.
that's kind of how we think at all times. We're always making sure all documents are ready. Even when we're doing bookkeeping, we're always questioning, asking the business owner, so what was this about? Send us the receipt or send us a doc, especially when it's a big chunk of change.
Right.
And of course, depending on the type of service that we're doing and the level of service. But anything that's outside of the norm is always we question it. We just can't help ourselves. We were auditors forever.
Yeah.
So, but yeah, well, we've gone a little bit over our 30 minutes, but this was such an exciting conversation. And we did cover a lot of great information. Thank you, Pedro. This was really great. I think our audience enjoyed it, and I've had a few notes here. Very good info, Pedro. Everybody's enjoying it. We've got some loves and likes. Thank you so much for the love, and thank you for the support. We really appreciate it. So with that, we'll just go ahead and say we'll see you next week. But before that, always I want to leave you with, just remember who are the top 5 people that you're surrounding with yourself with. Always make sure you surround yourself with people that support you and help you grow and do better every times. And we hope that the both of us are the 2 of the 5 people that you are surrounding yourself with. So with
Right.
that, we'll see you next Thursday with the normal schedule,
Yep.
January 27th. Goodbye, everyone.
Okay. Take care.